Looks like people are starting to trickle in now.
Okay.
We're going to give them maybe a couple minutes as people get situated. There we go. It's a lot easier to have people file into a virtual conference room than, real life as people run through the door.
Yeah.
So, thank you guys. It looks like we're getting some people still coming in. We're going to give it a couple seconds before we get started. So get your popcorn ready. This should be an interesting update. So thank you for joining us. Today we have Matt Potter from SEI. Matt usually comes down and gives these presentations in person during the fall. But this year we thought we would go ahead, given the unique nature of all of this, and we're all quarantined at home, we thought we would have Matt attend virtually with us and give us a good presentation just on SEI's views and their market updates and economic updates. So thank you, Matt, for joining us. We have a couple of updates I was hoping to share from our side of things. So OWM is continuing to work from home. We're finding it effective, and we're not really losing anything by being remote. So we're happy that we can continue our services to all of our great clients remotely. I was just joking with Matt ahead of getting this started that we're so surprised that the internet has functioned really well for a lot of us. There hasn't been, too many instances of us dropping off calls or losing connectivity. So we've been really happy about that. At this point, the firm is anticipating continuing to work virtually through the summer. So we'll see how that goes. We'll stay up to date. We are working on a plan to get back into the office and then still thinking through what client meetings will look like in the future. We're sure things are going to change and be fluid. So we're open to changing and evolving with updates and the times as they happen. So we have added electronic capabilities for everyone. Maybe some of you have already noticed that. We've done a lot of work to get DocuSign for our documents, as well as SEI's documents and some other custodians that we're using. And we're using video conferencing to meet with our clients, which we have found have been really great while we're all quarantined. We do lose a little bit of, we're not quite 100% of the face-to-face interaction as you would get in person, but it's been a great way to continue meeting with all of our clients. We are looking to bring on a new experienced associate sometime in the next few months. So we'll be looking to do that shortly. We're in the process of interviews and we're really looking for a good fit. So hopefully in the next couple of months, we'll be able to let you know who that is. And last but not least, Lisa Kirschenbauer will be presenting a 3-part series on coping with the lockdown and return to life after COVID-19. So stay tuned for some information on that. We're going to do a 3-part webinar series, and we hope to get that going pretty shortly. So without further ado, we have Matt Potter with us today. Matt Potter is the Director of Investment Services with SEI. He's been with SEI for 13 years. He has over 25 years of experience in the financial services sector. He's worked with a couple of boutique smaller investment firms prior to joining SEI in 2013. Matt is also a chartered financial analyst, which is the gold standard for investment services in this field. And like I said earlier, he's a local guy, local native to this region, and we're happy that he can join us today and give us some updates on what SEI is thinking about in the markets and the economy. So without further ado, take it away, Matt.
Great. Thanks, Jared. Thank you for inviting me, and thanks to everyone for participating. Hopefully you're able to see the presentation. I'm still learning technology and kind of best practices in terms of how to share things. So I do want to talk about not just what's been going on with the market, but also at the end kind of how SEI has been dealing with client portfolios, some of the actions we've been taking. But I think it's a good time to also say up front, we too have had, I think, large success with the work from home environment. I think literally 1% of our workforce is actually in the offices. So the vast majority of us are working remotely. And so far it's gone pretty well. We haven't had really any glitches. The connectivity's been very good. We've really been able to function efficiently, and we're going to slowly start to bring people back, but I don't think we're in a great hurry, and with southeastern Pennsylvania kind of being the way it is, caution seems to be warranted. So it's probably going to be more of a gradual phasing in. I believe at the end, I do want to allow some time for questions, and certainly I think you can, during the presentation, if you want to enter something into either the chat box or the Q&A function, that's fine. And I'll let Jared kind of MC that, or sort of maybe collect those as we go along.
Yeah. Sorry, I forgot to say that to everyone. You can also, it looks like with Zoom, we're new to Zoom, but it looks like you have the ability as a guest to raise your hand, and by doing so, I'll have the ability to unmute you. So if you choose to ask your question that way, I'm happy to give that a shot. Otherwise, the Q&A session should work just fine, and I'll tee those up for Matt at the end. So thanks.
Great. Okay, terrific. So let's jump right in. I will start with, here we go. I updated these numbers through April. Unfortunately, they still are, for equities especially, in fairly negative territory year to date, and also for the trailing year as well. The green bar here is the year-to-date performance of different asset classes through the end of April, and then the gray is for the one-year period through the end of April. And as we all know, the coronavirus really precipitated a very significant market decline, particularly for stocks, but also for a lot of bonds. Much of what I talk about over the next few slides is going to be about stocks in particular. I will have one slide on bonds, but just to say a couple words up front, it seemed like one of the only places to hide during the market sell-off was in high-quality investment-grade bonds, particularly U.S. Treasuries. And this is typical when you have a very strong flight to safety. Often it's going to be Treasuries that are most preferred that investors typically will kind of flock to. And so, it makes sense that that would be the asset class that really, did the best. Other forms of fixed income, even high quality municipal bonds, faced some selling pressure and also some liquidity pressure, although steps were taken, particularly on the part of the Federal Reserve to help deal with that. And there was a partial rebound in April, and again, I'll talk a little bit about that as well in terms of what we saw, where we are now, and where we think things may be going in the future, though there still is a fair amount of uncertainty. One of the trends that we've seen for quite some time has been U.S. outperforming non-U.S. stocks, large caps outperforming small caps. And as we've seen here, when you look at the style difference, growth stocks, stocks with generally higher expected earnings growth, which also tend to be traded at higher valuations, have been doing better than value stocks, which often are more cyclical companies, companies that have just been at cheaper valuations. Over long periods, value can do very well. We actually think that this really has been setting up for a strong period of value performance looking forward. But so far, it's been unusual this year because we've seen growth do very well, better than value, not just for the trailing year, but also year to date. And the bottom chart shows the sector performance and why that's been the case. And the best performing sector year to date has been technology, which is a little odd. I mean, typically when you have a market decline, the defensive sectors such as consumer staples and utilities are going to be the ones that hold up best. People tend to kind of flock to those because they tend to be more stable business models, higher dividend payers. And they did hold up for a period during kind of the worst of the decline, but really technology was held up pretty well during the period of decline, rebounded very strongly in April, and really has been market dominant for quite some time. I think part of that may have been due to the predictability of earnings that we've seen with a lot of these companies. Part of it probably is from indexing because they do represent a large part of many indexes. Part of it also, I think, was thematic, that a lot of people saw a work from home environment as favoring a lot of technology companies. And certainly I think that is the case, though to what extent they're factored into valuations remains to be seen. The areas that were weakest, energy shouldn't be a surprise at all. Oil prices really fell dramatically. They have since recovered. a fair amount, but really there was the start of a price war or a clash between Russia and Saudi Arabia about how much production OPEC should be having, what should be done with prices, and that kind of turned into a price war and brought prices lower, which had some difficult implications not just for energy companies but also high yield bonds, because many of those energy companies often are issuers within that particular asset class. And then other sectors that struggled were the more cyclical sectors, again, kind of your classic value sectors, financials, industrials, and materials. Now, what was kind of frustrating about this was that things were actually looking fairly good at the beginning of the year. Leading into the year, we were starting to see some positive or upturning economic indicators globally. We had finally gotten resolution to Brexit, or at least we knew what was coming. We finally thought we were seeing more of a détente between the US and China with respect to the trade war. And it seemed like many economies were at least bottoming out and beginning to improve, if not starting to strengthen. And I think based on some of that optimism, we saw markets within the U.S. hit all-time highs as recently as February 19th. Not all that long ago, although it feels like a lot longer ago. But then, coronavirus hit, and I think kind of the perception of how big an issue it would be in the U.S. Was kind of evolved over time. We first saw the impact directly within China, and a lot of that had to do in terms of what was going to happen with the global supply chains, what was going to happen with the ability of China to manufacture many of the components and assemble many of the components in technology products, in cars, in a number of other goods. And so the concern there was kind of more on the supply side. Then as it spread to, first the West Coast, and then I think really when it hit the East Coast and the big population centers along the Mid-Atlantic, I think that's when investors really began to worry and figured that this might be much more severe than they had originally anticipated. And so that really was, roughly when the decline really became much more dramatic. So what we saw then was at its worst, markets declined very significantly. These are all numbers through the end of March, which show, and I think the one to really look at is the peak to trough decline. So again, from that high of February 19th through March 23rd, and for the other two indices, these are, the blue is the US, orange is the developed international market, and then this light green is emerging markets. Emerging and developed international started their decline earlier, about mid-January, again, because the impacts of the coronavirus were being felt in those regions before they were within the US. But from their peak to their trough, markets fell a similar amount, about 34%, give or take. Again, for the US, this was a very short period, February 19th through March 23rd, just over a month. You do not normally see these kinds of declines happen that rapidly. Even in 2008, where we saw some severe market declines, it took longer for markets to experience that kind of selling. So it was very quick. We've heard the word unprecedented a lot, and I think a lot of people have used it. It may have lost some of its sting, but there were a lot of things that were unprecedented about this particular market decline. Now, one of the sort of, I don't know if it's a bright spot, but at least worth taking note of, was in the middle of March, we got to a point where an important threshold was breached. We look at a number of different metrics with respect to stock prices. We don't try to be market timers, but we do want to keep an eye on what's going on and try to determine if patterns have emerged that we've seen before. We did see a pattern where 90% of stocks within the S&P 500 index had dropped significantly and quickly, and thus gone below their 200-day moving average. Again, one of the statistics that we watch. And this hasn't happened very often. Again, only 6 times before this year. And in most of those instances, that represented an important market low, or at least close to a market low. This chart shows from those previous instances, in 5 of them, if you moved forward 6 months, markets had recovered on average about 12%. Now, the one exception to this was 2008, shown in the orange, where there was a lot of systemic economic damage and also damage just within the financial markets themselves. And so it took a lot longer to sort of climb out and even to reach the ultimate bottom. But even if you move forward a year from breaching that threshold, even 2008 was in positive territory. Now, what we've seen more recently has been a bit different and again, more accelerated. From the market bottom, again, that was March 23rd, at least so far, was March 23rd of this year. From that point through yesterday, US stocks are actually up about 33%. Down a little bit today, but again, and that's just over a 2-month period, or just about a 2-month period. So a dramatic 1-month decline and then a very strong 2-month rebound. So we think stocks did get to the point where they were oversold, and we did see a rebound happen after that overselling point. We're not sure that we're completely out of the woods, though. Again, things kind of in markets can go to extremes, and they can do that very quickly. And just as you can get into oversold territory, you can also get into overbought and overly optimistic territory. And I think the sharp rebound that we've seen might be an indication of that. Now, as I mentioned, one of the anomalies that we've been seeing, and it's just really been widening, has been the market preference for growth stocks at the expense of value stocks. Again, the growth stocks being those that normally do trade at premiums, at higher valuations than value stocks. They do expect to have higher rates of growth, but there are periods when expensive stocks or higher growing stocks can do better, and there are periods when inexpensive stocks, value stocks, can do better. This blue line, when it moves up, value is doing better than growth over the trailing 10 years, and when it's going down, growth is doing better. And you can see that the point we're at now is fairly extreme. It's at the 2 standard deviation level, and it is almost at or around the point where we were at the bursting of the tech bubble. Now, that doesn't necessarily mean that 2 standard deviations is the magic number that you get to before things do reverse, but I think it does show that this market preference has been very strong, and we think has gotten to a point of being quite extreme. We have thought that value even represented good or attractive an attractive sub-asset class even prior to this, but with the most recent market activity, we do think that growth has really gotten more expensive and that value does look quite compelling. Now, just because something looks compelling doesn't mean that it's going to turn around immediately. Usually you need to have some kind of catalyst for it to happen. We may be seeing one or approaching one for value, because what we've seen historically is when value does well, it normally does well as markets are coming out of an economic contraction or recession and turning up. So when markets anticipate that the economy is going to turn and things are going to get better, typically that's when value stocks start to be preferred very strongly. So again, in a year like 2009, pardon me, for example, when we've seen economies start to turn up, that has generally meant good things for value. Now, we don't know, again, if we are at the bottom or approaching the bottom, but we do know that we are in a difficult recessionary period right now. At some point, we will reach a bottom, and at some point, it will turn around and things will improve. And so we don't pretend, again, to be market timers, but we do anticipate that that is likely to happen, and probably sooner rather than later, or at least within the foreseeable near to medium term. So again, the tilts that we have within our portfolio where we have been favoring value a little bit more than growth, not to say we've gone out of growth completely, but do have a more of a position in value. We think that when we get to the point where markets begin to discount a recovery, and when we start to see a recovery unfolding, that should, we think, bode well for value if the past is any indication. So that's a little perspective. We've put out a few papers on this subject, but I wanted to touch on it because this does represent an important positioning within our portfolios. Now, I said I wouldn't say too much about bonds. I just have this one chart, and I've shown this before and talked about the yield curve. So these are U.S. Treasury securities, which are bonds issued by the government. Pardon me while I take a lozenge. Hopefully this will help my voice. So these represent U.S. Treasury bonds and the interest that those bonds pay depending on how long you borrow them from the Treasury. So if you borrow, say, a 2-year bond, you generally expect to get less interest from that than if you're borrowing a bond which matures in 10 years where you get your money paid back. Now, normally, the curve slopes up, meaning that the further out you go, the longer term a bond you buy. In other words, the longer you're tying up your money, the more interest you can expect in return to compensate you for doing that. So when we looked at the end of 2013, you could see this was a normal upward sloping yield curve. Now, one of the reasons why this got attention last year is the yield curve inverted. In other words, it came to the point where it was downward sloping at certain points. And that usually is predictive of a recession. Now, I'm not saying the yield curve was somehow predicting the coronavirus to occur, but that is kind of how things worked out. As we look at the curve now, though, which is this blue line, rates are extremely low compared to where they've been historically. Even in 2013, they were low compared to where they had been historically, and you can see they are much lower now. Part of that was the Federal Reserve lowering rates. Part of it also was, again, investors really wanting to own U.S. Treasury bonds. That flight to safety, again, usually means that you want to own the highest quality assets you can, and typically that has meant Treasuries. And so that has driven the yields lower because there's an inverse relationship between price and yield. And so, again, all of that to kind of say that bond yields have come down, which means prices have been favorable recently. It also means that, you know, there may be a little bit more room for yields to go lower. We do not expect yields to go into negative territory, at least not by policy. Jay Powell, head of the Federal Reserve, has been asked that question many times, and he is saying the U.S. is not looking to set a policy of negative interest rates. We've seen those in a number of countries in Europe, for example. It hasn't really helped as much as was expected, and there are a lot of unintended consequences. It can be significantly bad for banks and other companies within the financial services industry. So we don't expect to see that. And again, not all bonds are like U.S. Treasuries. Again, some bonds had kind of a tougher time of it this year. But in terms of where interest rates are they are quite low, especially compared to historically. And we expect they probably will remain low for some time going forward. The Federal Reserve has been buying a lot of U.S. Treasuries, putting it on its balance sheet as one way of trying to help out the economy. And so, you know, with all these factors, we do expect to see yields in fairly low territory for quite a while. So this blue line may be something like the new normal for at least a period. Again, we don't know how quick the recovery will happen, but it is likely that rates will remain low for quite a while, as they did after 2008, that financial crisis, for example. So what does all of this mean kind of as we look forward, as we think about what we've seen and what we might see in the future? Well, first of all, again, the economies within the US, within Europe, one economist described it as kind of like a medically induced coma to save the patient. That essentially we brought the economies to close to a full stop by basically, having people shelter in place, having people stay at home, having consumers, not go out and spend. So that has meant particularly negative things for, the travel industry, the hotel industry, for restaurants, for many retailers, but also with people not able to work. It has meant really a very significant slowdown. But that does seem to be the best way to approach this health crisis, and the best way to deal with an economic crisis which was rooted in a health crisis is to solve the health crisis, and the rest should be able to take care of itself. We have seen governments intervene, both on the Federal Reserve, as we've seen in the US. They've pulled out a lot of stops. They've done a lot of things, some of which they did back in 2008, some of which they hadn't done before, and maybe setting new precedents for intervention. We also have seen governments begin to allocate more money on the fiscal side. So, you've seen a number of bills pass through Congress where, in allocating literally trillions of dollars of resources to individuals, to large companies, to small companies, to companies in distress, to cities and states, to a number of parts of the economy. Again, really that we've seen a lot of aggressive action. Likely more is going to be needed. But I think that was when you started to see markets begin to reverse course and move positively, was when they saw the US government step up and begin to intervene fiscally, because they realized, the Federal Reserve can only do so much, but we think that now we're going to see things start to improve as we see more intervention from the U.S. government. So, again, as I said, stocks in the U.S. and other countries as well fell very quickly. They got to a point of being oversold. At that point, they probably had, it had been such a waterfall, they probably were discounting much of the decline. But again, they've recovered from that point. So that leads us in a place where things are a little bit more uncertain now. As we look at China, again, that's where the virus started. That was the first country that really kind of started to recover from it, though there may be some additional waves of the virus that we're seeing now. But generally speaking, China has been able to start getting their people back to work, to reopen factories. And so if we start to see the kind of recovery that we are hoping for, then China can kind of serve as a model for the rest of the world, in at least the fact that a recovery can happen. And when it happens, it can be a fairly robust one. So if China does begin to ramp up again successfully, I think that serves as a guidepost for everybody else. It also helps both importers and exporters. It helps Asia and countries in the emerging market, and it helps developed economies as well, being an important trading partner with Europe, for example. So a strong China, a good recovering China would certainly be a good part of the overall recovery as it unfolds. And again, as I mentioned, we think value may once again be poised to take over a leadership position. But you always have to be aware of, what are the things that could go wrong, or what are the potential issues. One of them is, again, as I mentioned, stocks really had fairly strong rallies from their lows and may experience another pullback. Now, we don't know for sure. It is possible that we have seen the market bottom, and it is possible that stocks could go up further from here. We don't think that's the most likely scenario, though. Typically, again, when you see this kind of massive disruption in economic activity, it takes more than a decline hitting the bottom, and then it's not like an all clear signal is given and everything is going to be going positively from then on. There are a lot of uncertainties about, how will the virus be contained within the U.S. Will we get a vaccine as quickly as some people may think, or a treatment? Will there be a second wave, either when people start to return to work, or states begin to open up again, or potentially if it's seasonal, if it starts to fade within the summer, could it come back in the fall, like other viruses have shown in the past? We don't know that. We also don't know what's going to happen with earnings. And usually over long periods of time, earnings are what drives stock prices. And there's a lot of uncertainty about earnings growth. So whether companies will be able to recover and restore their earnings, and also how much leeway markets will give to that, a lot of that remains to be seen. Markets are forward-looking, and that is something that's important to realize, because a lot of people have asked, well, why are we seeing strong markets in April and now, when the economic data are so bad and we're still seeing cases and deaths from the virus? And again, markets generally look out, whether it's 6 months, 12 months, or a period of years. Markets are kind of anticipating what is up next, not necessarily what happened last quarter or last year, but what could we see on the horizon. And to the extent that markets anticipate that this could be this is a finite event and that there will be a recovery, they often can sort of overlook the period of struggle in between, keeping their eye on the longer term, on when things will recover. So it's hard to predict market strength just based on economic strength. They aren't always correlated. But really, we think this time around, it's the virus that's going to be the main factor that drives both how quickly the economies, particularly in the U.S., can kind of get back to full strength, and also when markets can start to rally in earnest. So again, we wouldn't be surprised if there were a pullback, if there were a retesting of lows. Again, we don't know, and we don't try to be market timers, but we do think that if past is any indication, again, there could be periods where the news is very good and people get optimistic and hopeful, and there could be periods where it's bad. You might see a potential vaccine that people thought looked good suddenly not make it through the phase 2 or phase 3 clinical trials. There might be a setback in terms of new cases. There could be again, more outbreaks in other countries, or a number of things could happen. We just don't know. It's entirely possible that there could be negative news that surprises people, and that could be something that could drive markets further down. So we think it's too early to really say that we have already hit the bottom. And again, there's not just the U.S. and also Europe, but also emerging market economies, other countries. Latin America, I think is having a really tough time. Africa, there are just a number of countries where the healthcare systems aren't equipped to take on something like this. Many of those countries also are probably going to have to borrow significantly, and to the extent that they have different currencies and need to access the global capital markets and borrow in dollars, for example, that could wind up representing a risk for some of those economies as well. And lastly, again, as I said, while the Federal Reserve has done a lot, they can't necessarily do everything. There are a lot of things they've done to help backstop the economy, to help backstop trading, capital markets, our payment mechanisms, the functioning of bond trading, all those kinds of things. They've done a lot, but really there isn't they don't have a magic bullet. And even with the amount that the government has been spending on the fiscal side, we don't know if that's going to work as hoped. We don't know if the money will get into the places where it's most needed, or if it will have as much of an impact as market participants may hope. So, there is always doubt and there's always uncertainty, and markets typically don't like uncertainty. So again, we do think that there will be a recovery at some point, but we don't think that the timing of it is easy to really determine. There is likely to be a vaccine and treatment out and available in the future. Once that happens, it is likely that the economy will be able to be restored to reasonably good function, maybe not exactly like it was before, but certainly in a much more positive direction. But the timetable for when that happens and what markets are assuming about that timetable still is very much up in the air. And so I think it's important really to keep that in mind. Now, a question we also get is, okay, so what is SEI doing? What's your approach to periods like this? And I would say a couple of things. One is, when we create portfolios, we don't think about just a market, portfolios that'll do well in a strong market. We want to have portfolios that are robust and can perform in a variety of markets over a full market cycle. We expect declines, we expect bear markets to happen every so often, and so we design portfolios with those expectations in mind. We have a goals-based approach where we try to have portfolios that are either focused on downside buffering or protection or some form of preservation versus growth versus income or distribution portfolios. And those portfolios are constructed very differently. They look very different from each other. And that's really by design. So depending upon what your goals are, how soon you need access to your funds, things like that, the portfolios are going to vary. We're big believers in diversification. We think owning a number of different asset classes can be very helpful because you never know when a market decline is going to hit, and it can hit very, very quickly. So again, having exposure to bonds, having exposure to cash, to some of those safer assets, can be helpful, but again, you don't necessarily know exactly when that's going to occur. Rebalancing is something that we do on a regular basis. We work with our advisors to make sure that it can happen systematically. That basically means taking portfolios back to target. So if you've had a period when, say, bonds have held up well, but stocks have really sold off, rebalancing would be taking assets away from what has done well and moving it to what has done poorly. And over time, that's been shown to help returns and also help reduce portfolio risk. So that's something that that also can show its worth over long periods. Don't know how much you can see, but there's a black and white cat who is getting very curious about what I'm doing here. I will try to keep him. No, Skippy, stop that. At somewhat of a distance. I say every day is bring your pet to work day in the new environment, and it can be interesting. So in particular, again, we have what I mentioned, the stability focused strategies, models that are designed
Looks like we might have lost Matt. I can hear you again, Matt.
See if I can
restore this. Let me see if this works. Oh, okay, here we go. Let's try this.
All right, you're back.
Good. Okay. Sorry about that. Yeah, Skippy is not.
Was that Skippy messing around with the wires?
Yes, it was him. I will blame him, and it is a fair person or being to blame. Where the heck do you go now? Anyway, so two of the other things that to focus on really quickly. Tax loss harvesting. When assets fall a lot in prices, you can have the opportunity to sell something at a loss and buy a replacement asset. And that way you can lock in that loss, which can be used to offset gains. That can be done in a variety of strategies. We have ETF strategies that do this. We do this within some of our mutual funds or separate accounts. So that's one way that you can take advantage of market volatility and help your portfolio's tax efficiency. And that's something we are set up to do, and I think do a very good, consistent job with that. And lastly, people have asked, what are your managers doing? Are you guys on your screens trading all day? And I would say we're not, and it wouldn't really make sense to do that. When you have disruptions like this, and again, I worked on the the portfolio management side. Typically, what you want to do is go back to the companies you already own. it's kind of a triage process. You want to look at, okay, which ones might be in trouble, which ones might have weak balance sheets or might be at risk of going out of business, and those are generally the ones you remove from the portfolio first. So we did see some of that activity from some of our managers. We then see assessment of, okay, what do we own? Let's talk to management. Let's look at the business models. Let's kind of revalidate our investment thesis. Do we still like holding this company? Is it still one that we favor? And then managers often will have wish lists where there are companies that they like the fundamentals, but they may not like the valuation. It might be too expensive given its growth prospects. But if the value of that company falls along with everything else, that may present a buying opportunity. And we have seen managers who have stepped up and bought, or even shifted out of a company that they had a decent level of conviction in, and bought one where they have high conviction. So you do see some of those trades as well. But generally speaking, we haven't seen managers just rapidly trading their portfolios completely, because to do that kind of short-term repositioning, when information is changing so quickly, when there still is a lot of uncertainty about where things are going to ultimately land, we generally want to hire managers who are going to take a longer term view, really do the fundamental work on their holdings, and who aren't going to suddenly change their stripes, suddenly try to time the market or get defensive as a result of market volatility. So there has been some manager activity, but again, it hasn't been anything really that's gone off the charts. So with that, why don't I'll turn it back to Jared to see, are there any questions at this point that have come up that I can address?
Yeah, we got a couple.
Okay.
So we know that, or we suspect that municipalities have probably gotten hit pretty hard just by the loss of tax revenue from people not buying things like sales tax and that kind of stuff. So what, in your opinion, over the next 12 months, what do munis look like in your view?
Yeah. So you're right. Munis do have faced some issues, not just on the trading side, but also worries about, are they going to have enough income, enough revenue from whether it's property tax, whether it's income or sales tax. What I think it means is that you do want to be selective. Generally, I think the managers we work with and our own internal bond desk have favored things like essential services. So bonds that are issued by water departments, for example, or sewer departments. Things that are maybe kind of boring but are necessary and are still going to be used and are still typically going to get the steady cash flows that they need and be able to service that debt. There are also general obligation bonds, which is for kind of the full taxing authority of a particular state or municipality, as opposed to one that is a revenue bond that's tied to a specific project or a particular source of revenue. A turnpike bond, for example, if the traffic is much lower and there's less revenue coming in, that's something that could be hit. But if you have a general obligation bond, many states and municipalities have rainy day funds, which they're able to use. They also can go back out to markets. I think another thing to keep in mind is that while we don't know how the election is going to, what's going to result in the fall, it would not surprise anyone if tax rates were to go up, or at least not go lower, given kind of where the federal deficit is. And so the demand for tax exempt income probably is going to be greater going forward. And so if states really want to issue municipal bonds, there likely will be demand for it. But I think it is a good time to be selective, to work with active managers, and we think really to kind of pick your spots, look at the different economies, know your securities very well, and really do that work. This is a kind of time when that can be extremely important, because there are some areas that will no doubt experience some stress in the months and quarters ahead.
Sure. Yeah, great. So you talked about potential for retesting lows. I'm wondering if there's anything in particular that you're looking for that might signal that, hey, we're not going to be heading up like we have been. We're going to be looking at the markets declining. Is there anything in particular you're keeping an eye on?
That's a great question. To some extent, I think it's probably going to be the news flow with the virus itself, because I think that's been what's sort of been leading markets much of the time. We had a big rally a few days back when there was, word of a vaccine, which I think there were a total of 8 participants in that study or something like that. I may be
Mm-hmm.
misquoting, but the news flow. So to the extent that the news flow, may turn more negative. That's something to look at. Also, I mean, as you start to see directionally, people may be traveling more for Memorial Day weekend, even if it might be a little too early to do that. We've seen instances of travel where people have gone somewhere and then there's been a big outbreak when they've returned, or areas of the country that have opened up. We need to keep an eye on, is this happening too early? Are steps being taken, et cetera. I think the other thing also is, even if we do see positive news about the virus itself, what will the recovery look like? How quickly can people get back to work? And even if people can, will they want to? Will people want to go to a shopping mall, or want to, take a cruise or fly in a plane, if they have the option to do that? That remains to be seen. So I think there are a lot of economic metrics to look at that are kind of more real time. I think those are important. And just looking at corporate earnings, are earnings expectations reasonable relative to where we think they may go? And we have conversations with our managers about what they're seeing at the company specific level. We see what's happening in the bond markets, and often that can give you an indication of what bond professionals think of what's happening with the economy. There are a lot of things to look at. Again, you never really know until after the fact. But just given what we have seen previously, and given that a lot of the rally, I think, has been very strong and based off of a lot of positive news, some of it is kind of the law of averages. You would expect that it seems likely that there could be a period where the news becomes less positive, and that may wind up being leading to further market weakness. Again, I think there are a lot of indicators to look at, but I don't know that there's really one that would very definitely point to whether we
Yeah,
continue to go up or turn back down again.
that would make it way too easy, I think, for
Yeah,
people.
sadly, yes. Yeah, if only.
So I'm going to try and interweave 2 questions into one here. So first, someone wanted to know what your view on these mega cap tech companies were, like Amazon and Facebook and Netflix, maybe, and the FANG stocks. And then second part to that question would be, what, in your opinion, could kind of derail value stocks versus growth stocks? SEI is positioning value stocks for maybe a better valuation compared to growth stocks, and taking advantage of that. What, in your mind, could derail that from coming to fruition?
Yeah, sure. I would say, generally speaking, we do recognize that technology, that a lot of companies really have been disruptors, and they really, things have changed in a lot of areas. We're not just sort of sticking to, old economy principles. We do recognize that things do adjust over time. So, many of these companies could deserve the valuations that they have. But, when you've seen how much, the FANG stocks, I think, make up about 20% of the S&P 500. So a lot of them get traded with index funds and kind of with the market as a whole. We think the earnings estimates, there is a lot baked in about maintaining their profit margins. And, if there are concerns about, can they sustain this level of growth? Could there be any regulatory risk, things like that? We just see them as kind of over-owned and over-loved relative to what their growth rates have been. And there's a big difference too between liking a company and the concept of the company and how it executes, versus liking the valuation for it. You could love a company and think it's going to be very successful and do well, but if the stock is priced too high, you may not make money with the stock. And so I think we're seeing that just have gotten more and more stretched. That's not to say we think you should give up on growth. We do have growth within our portfolios to some degree, but we do think value does look compelling. I would say if we get indications that this period of economic weakness stretches out longer than people are expecting, if this turns out into a multi-year type of event, then that's something that I think could push off a value recovery longer. Again, that's not something that we see as our base case, but typically that's something, because then that would really hurt some of the cyclicals even more, and they just wouldn't really have a reason to rally. So really an extended period of weakness that goes well into next year and potentially further, that probably would be one factor that could be problematic.
Yeah, it's gotta be tough for the managers, right? I think I've read that there used to be an old saying, "You don't get fired for holding IBM." I imagine the same can be said for Amazon and Apple and the big tech companies right now. So it's got to be a little tough.
Exactly. Yes, I would agree with that.
Yeah. Looks like we have one last question, maybe. There's been a lot of concern over the national debt and the Fed kind of running up their lending programs. It looks like the current scenario is a good test for the modern monetary theory folks. We're getting a real live test case here with printing money. And if there's ever been helicopter money, this is definitely it. So at what point do you think the national debt would become a concern when you're looking at the financial markets?
That is a great question. It's one that I got even before all of this spending happened. It's a hard one to call, because most economic theory, and I think that may be one reason why modern monetary theory is getting a second look, it would assume that issuing these kinds of levels of debt should result in inflation, and we have not seen any indicators of that for the last several years. One of the tenets of modern monetary theory is that this is the time when you want to borrow, when rates are extremely low.
Mm-hmm.
And that at least allows you to be able to service your debt. Now, whether there's fiscal discipline within Congress to pull back on the spending and start to repay and reduce the size of the national debt when rates start to go up, when the economy begins to strengthen, that remains to be seen. I haven't seen a whole lot that gives me a lot of confidence in Congress's ability to do that, but that could be a surprise. But I think at least when you look at our debt to GDP, especially if we do start to experience a pickup in growth, it is definitely on the high side. The debt, though, with interest rates where they are, is still very serviceable. We start issuing 20-year bonds again. There had been talk of 50 or 100-year bonds, but I think that's been shelved because there wasn't seen as enough demand. But there still is appetite for dollars and for U.S. Treasuries. We are still the de facto world currency, and as long as that is the case, unfortunately, it probably means that there can be continued borrowing, but yeah, you have to wonder about moral hazard or fiscal hazard, whatever you want to call it. It can't continue on indefinitely, but at least for the moment, with rates as low as they are, the ability to service that debt has so far been a plus. If you start to see rates go up and the debt becomes much harder to service, then you really could get kind of a parabolic negative impact. So that probably would be the big thing if you start to see rates really turn up quickly.
Right. Looks like we have actually one last question. I think we have a couple minutes left. One of our clients, it's more of a planning related question, but I'll give it a shot to tee up for you. With the passing of the CARES Act, RMDs were put on hold for this year. Yeah. Let's say you're in a position where you really feel like you want that RMD. What type of funds would you be looking at to pull your RMD fund in the current market conditions?
Probably, generally speaking, and again, it's hard to time markets. It's hard to really know. And also, if you do pull from a part of your portfolio, then you're kind of putting the rest of your portfolio in imbalance. But I think one thing you can look at is maybe what is your target allocation. So, like if you were to rebalance your portfolio back to targets, what would that involve doing? And if it would mean that you were going to sell, say, some fixed income, or even right now, if you were going to sell some, U.S. large cap growth because it's recently done well, then that could be something. If selling it would get you closer to your target allocation, that probably makes sense to do that. But it's hard to know. If we have seen kind of sort of the extent of this current rally, and if there is going to be another downturn, then obviously you'd want to look for what has done well recently and maybe about to turn around. But again, that is admittedly is market timing. We don't know if that is the case, because if things continue to go up from here, then that theory kind of doesn't hold. So I would say kind of looking at target allocations and what would you be selling anyway if you were to rebalance probably makes the most sense, because that's going to get you back closer to what your portfolio should look like ideally, and probably would have the least overall impact on the overall allocation. But also probably a good planning question, and a good
Yep.
question to definitely get a second opinion. That's why
Yeah.
you hire these good folks.
That's why we're here.
Yeah, exactly.
Yeah, we're definitely recommending to clients, hold off on taking the RMD if your cash flow can support that. We don't want to be selling in down markets. We don't want to be trying to time the market. So if you can feel like you can get by without it, we're saying hold off. And I've got another good question coming in. So I know I said that was the last one, but but this one's a good one. I know we talked about this being a political election year.
Yeah.
It's hard to kind of think about that right now, just given where we all are. We still got an election to deal with come the fall. But in SEI's view, is there any pros and cons for either candidates? Should one get elected over the other? And I get that this is a touchy question, so
yeah. Let's see. I'll try to be as neutral in answering as possible.
Right.
Well, I guess what I would say is, first of all, if 2016 showed us anything, the old rules probably don't apply. And so, you can look, when we've seen, depending on if you look at, do stocks do better under, a Democratic administration or Republican administration? Some of that depends on, do you include Herbert Hoover in the Great Depression or not? So you can sort of fudge the data a little bit. I don't know that there is necessarily a dramatic trend one way or the other. I mean, you can think of markets and stock that have done well under both, and you can think of markets that have done poorly under both. Generally, in the past, what Wall Street has liked to see is divided government. But, we have divided government right now. And, the coronavirus, again, just kind of came out of nowhere. So I don't know that there is necessarily a strong preference. What I think often can rattle markets is if everyone is expecting things to go one way, usually they've valuations have already adjusted by the time you get to November. I think we saw that in 2016 because a lot of people were surprised that the election went the way it did, and it's surprises that generally can rattle markets. But I think it's probably going to be less of a factor going forward, just given that things have been very unusual, and whoever is in charge will have to deal with much larger national debt. We'll have to deal with the ultimate long-term economic recovery from the coronavirus. There will be other issues to deal with as well. So I don't know that there is really a consensus that one would be better than the other. I think it's just the old rules don't seem to apply this time around.
Yeah, absolutely. We all have our personal opinions, but it's good to hear maybe the markets are ambivalent. So hopefully we don't have to worry about the markets come election time, but I think there's so much uncertainty. Time will tell. So
yeah, exactly.
I know you got to probably go through some of your disclosures real quick if you have those.
Of these. Exactly. Yeah.
feel free to read these word by word for all the people
Yes,
watching.
exactly. I apologize for those who are not speed readers, but we can always make these available if
Yeah.
necessary.
Yeah, we're going to be sending these slides around to clients who have attended, and then we've also been recording. So a recorded episode of this will be posted to our website in the coming days. On that note, Matt, it was great having you. We'll look forward to the next time we can see you in person. Not sure when that will be,
Yes,
but
we will see. Yeah.
we'll definitely look forward to that. And thank you everybody for tuning in. It was great having everyone. So thanks.
Thanks, everyone. Stay safe.
All right. Bye-bye.
Take care.